Now speaking, Jeremy Barnum, Chief Financial Officer. Good morning, everyone. Our firm reported net income of $14.5 billion, EPS of $4.75 on revenue of $42.4 billion, and delivered an ROTCE of 25%. We completed the acquisition of First Republic on May 1st, which contributed $4 billion of revenue, $599 million of expense, and $2.4 billion of net income. Excluding the impact of First Republic, revenue was up 21% year-on-year to $38.4 billion, driven by higher rates. NIR, ex-markets, was down $293 million, largely driven by net investment securities losses. Expenses of $20.2 billion were up 8% year-on-year, driven by higher compensation expense, including wage inflation and higher legal expense. Credit costs of $1.7 billion included net charge-offs of $1.4 billion, predominantly in card. The net reserve build included a $389 million build in the commercial bank, a $200 million build in card, and a $243 million release in corporate. We ended the quarter with a CET1 ratio of 13.8%, flat versus the prior quarter. Our new indicative SCB is 2.9% versus our current requirement of 4%, and it goes into effect in 4Q23. In CCB, revenue was up 31% year-on-year, driven by higher higher rates. Client investment assets were up 18% year-on-year, driven by market performance and strong net inflows across our advisor and digital channels. Credit costs were $1.5 billion, reflecting a reserve build of $203 million, driven by loan growth and card services. Net charge-offs were $1.3 billion, up $640 million year-on-year, predominantly driven by card. In CIB, investment banking revenue of $1.5 billion was up 11% year-on-year, or down 7% excluding bridge book markdowns in the prior year. Markets revenue was down 10% year-on-year. Payments revenue was up 61% year-on-year, driven by higher rates. In the commercial bank, revenue was up 42% year-on-year, driven by higher deposit margins. Payments revenue of $2.2 billion was up 79% year-on-year, driven by higher rates. Gross investment banking and markets revenue of $767 million was down 3% year-on-year. Credit costs were $489 million. Net charge-offs were $100 million, including $82 million in the office real estate portfolio. In AWM, revenue of $4.6 billion was up 8% year-on-year, driven by higher deposit margins on lower balances and higher management fees on strong net inflows. Record net long-term inflows were $61 billion, positive across all channels, regions, and asset classes. AUM of $3.2 trillion was up 16% year-on-year. Corporate reported net income of $339 million. Revenue was $985 million, up $905 million compared to last year. Credit costs were $243 million, reflecting a reserve release of $243 million. The effective tax rate was 19.7%, down from 20.3% in the prior year. Seaport Global Securities analyst Jim Mitchell inquired, Jeremy, could you discuss the implications of higher, longer-term rates on the outlook for next year and beyond? Jeremy Barnum replied, thanks, Jim. The drivers of the upward revision are higher rates and lower deposit reprice. In consumer banking, the combination of time passing and positive feedback from the field on CD offerings has created a stable environment. In wholesale banking, we're seeing slower internal migrations. We're seeing an increase in CD mix, which we expect to continue into next year. However, this level of need generation is not sustainable and we expect a medium-term run rate in the mid-70s. The exact moment when this will happen is dependent on competitive dynamics in the marketplace. Seaport Global Securities analyst Jim Mitchell inquired, given the lack of rate cuts until mid-next year, what confidence can you provide for the outlook of next year? Jeremy Barnum replied, I wouldn't assume that the evolution to the mid-70s number is sensitive to rate outlook. We looked at a range of rate environments and the reprice associated with that when we put out the number. It was meant to capture a through-the-cycle sustainable number, not one that is particularly rate-dependent. UBS analyst Erica Najarian inquired, Jeremy, what is your outlook on ROTCE given the potential haircut from Basel III endgame in the current rate environment? Jeremy Barnum replied, thanks, Erica. Our 17% through the cycle ROTCE was always premised on a normalized rate environment. With the proposed Basel III endgame, if more capital is in the denominator, our target could be affected. We feel confident about our ability to produce excellent returns through the cycle, and will adjust pricing where we have power to account for higher capital. We believe we can deliver good results through a range of scenarios, especially after the Basel III proposal goes through the comment period. Jamie Dimon replied, Erica, our businesses have a wide range of return on tangible capital employed, ROTCE, ranging from 0% to 100%. We believe 17% is a good target. Additionally, we have been consistently over-earning credit for some time now. We anticipate that as credit normalizes, it will consume more than the current rate of 3.5%. Autonomous research analyst John McDonald inquired, Jeremy, what strategies are you considering to mitigate the potential impacts of the Barr speech on RWA and GSIB? Jeremy Barnum replied, thanks, John. We are closely monitoring the potential proposal that is expected to be released this month. It appears that the biggest driver of the increase in capital requirements is the introduction of operational risk into the standardized pillar. This will result in a straight-up across-the-board tax on everything, making it difficult to optimize. We are looking at ways to adjust and optimize, but this time around it may require more fundamental changes to our business mix. Autonomous research analyst John McDonald inquired, what is the pace of building capital for new changes versus everyday investing in buybacks over the next couple of years? Jeremy Barnum replied, I can confirm that we are committed to complying with new capital requirements as soon as they are known and visible. We will not sacrifice investments that are strategically critical in order to comply with higher capital requirements ahead of the formal timing. However, there may be consequences to returns or pricing. Autonomous research analyst John McDonald inquired, what role will buybacks play in the company's strategy over the next couple of years? Jeremy Barnum replied, capital hierarchy is always at the top of our list when it comes to allocating funds. We have committed $12 billion for buybacks this year, however, given the new moving parts, that number may change. Buybacks are always at the end of the list when it comes to allocating funds. Jefferies analyst Ken Usdin inquired, what is your outlook on loan growth and investment banking fees as markets reopen? Jeremy Barnum replied, good question, Ken. In terms of investment banking and markets, performance is better than expected. M&A activity is lower due to regulatory headwinds, but it's too early to call a trend. Loan growth expectations are robust for card loans, but modest for other products. We're open to the right deals, products and terms, and we lend through the cycle. Demand will be a function of the economy. Jefferies analyst Ken Usdin inquired, can you provide more insight into the state of the consumer and how card growth is being driven by revolving debt versus deposits? Jeremy Barnum replied, I believe we are seeing a normalization of consumer credit, not a deterioration. Revolve per account has not yet returned to pre-pandemic levels, indicating that consumers are still spending out of want rather than need. The consumer continues to exceed expectations. RBC Capital Markets analyst Gerard Cassidy inquired, Jeremy, how have you adjusted the Treasury functions and asset liability of your balance sheet since last year in light of the low Fed funds rate? Jeremy Barnum replied, Gerard, our position on higher rates has not changed much. We always strive to ensure that our strategies are balanced across a range of scenarios, and we have been biased towards higher rates. However, with current rates, this bias may be less than before. We are still focused on making sure we are prepared for a higher rate scenario while staying balanced. We did not want to get longer in the First Republic deal, so we took steps to ensure that our net position was the same as last quarter. RBC Capital Markets analyst Gerard Cassidy inquired, what are you seeing in commercial real estate and C&I loans in terms of reserve building and downgrades? Jeremy Barnum replied, I would caution against drawing too broad a conclusion from our office portfolio. Our exposure to urban dense office is quite small, with the majority of our portfolio being multifamily lending. We observed valuations on office properties this quarter and felt it was reasonable to build a bit to get to a comfortable coverage ratio. We saw downgrades and upgrades across the rest of the middle market segment, but I don't see that as indicative of anything significant in the broader rate. Bank of America Merrill Lynch analyst Ibrahim Poonawala inquired, what are your thoughts on the potential credit cycle 6 to 12 months from now given the current unemployment outlook? Jeremy Barnum replied, I would caution against getting too excited about the recent trends. We need to remember that there is a range of outcomes and that loss rates still have room to normalize post-pandemic. NI is expected to come down significantly, so even in the central case, there should be some normalization. Jamie Dimon replied, the 5.8% unemployment rate is not a prediction, but rather an average of hypothetical scenarios used for Keckle. The consumer is in good shape with low borrowings and good house price value, however there are substantial headwinds such as the war in Ukraine, oil and gas prices, quantitative tightening, and unprecedented fiscal needs of governments. We don't know if these factors will lead to a soft landing, mild recession, or hard recession, but we should all hope for the best. Bank of America Merrill Lynch analyst Ibrahim Poonawala inquired, what changes do you expect to make in the capital markets business due to FRTB, and is the impact of Basel reforms on the U.S. economy falling on deaf ears? Jeremy Barnum replied, in response to the question, Vice Chair Barr's speech addressed the point of higher capital requirements increasing the cost of credit. FRTB is nuanced and requires a thorough capital allocation process. For example, yield curve spread options may become not viable. Mortgage products may become harder to offer to homeowners if the beneficial elements of the proposal don't come through. Ultimately, we'll have to wait and see what happens. Jamie Dimon replied, I would add that when it comes to product profitability, we need to consider the client and business mix. Loans are not typically included in a balance sheet, so we must manage the various complexities and determine the best course of action. Wells Fargo securities analyst Mike Mayo inquired, to what degree would you consider changing your business model if capital ratios increase by 20%, such as remixing where you do business, repricing, or removing activities? How much business could potentially leave JPMorgan or the industry if capital ratios go up as proposed? Jamie Dimon replied, this is indeed great news for hedge funds, private equity, and private credit. Apollo and Blackstone are sure to be pleased with the results. Jeremy will now provide further details on the matter. Jeremy Barnum replied, yes, Mike, repricing is definitely something we will consider to the extent that we have pricing power. We will attempt to reprice if the current capital requirements are not generating the right returns for shareholders. If repricing is unsuccessful, we may need to remix our products and services, which could mean leaving the regulated perimeter and going elsewhere. This could have negative consequences, so it's important to consider all factors. Wells Fargo securities analyst Mike Mayo inquired, why aren't you tempted to spend more given the additional $10 billion in revenue? Jeremy Barnum replied, Mike, you're suggesting that our expenses should be higher? Is that correct? Wells Fargo securities analyst Mike Mayo inquired, to clarify, it's the flip side of the question I've asked in the past. Jeremy Barnum replied, we have always been clear that our spending is through the cycle, based on our view of the company's earnings generating power and our goal to produce the right returns. NE tends to flow straight through to the bottom line, both when it's going up and when it's going down. We recently looked at opportunities to deploy more dollars into marketing, but I don't see that being a meaningful item this year, which is why we have not revised the expense guidance. This is about investing through the cycle and being disciplined about which revenue items carry expense loading and which don't. Jamie Dimon replied, we are running at full capacity and have taken the necessary steps to ensure that our operations are compliant, audited, and staffed with the right people. We are taking a thoughtful and careful approach to ensure that we get things right, not just financially but also in terms of personnel and the amount of change we can implement at once. Wells Fargo securities analyst Mike Mayo inquired, what is the current efficiency ratio and where can it be improved? Jeremy Barnum replied, you can't extrapolate the current numbers, but we're investing in technology to improve scalability and make our cost base more variable. We're investing in modernization, cloud, AI, and other areas to help us become more efficient. There's still room for improvement, but we feel good about our progress. Wolfe Research analyst Steven Chubak inquired, what are your expectations for deposit growth in the second half, both for your company and the broader industry? Jeremy Barnum replied, good question, Steve. Our deposit numbers have fluctuated due to regional bank turmoil and the First Republic transaction. We expect a modest downward trend going forward, but we anticipate taking share in consumer and wholesale banking. With the debt ceiling and TGA build, more of it has come out of RRP than expected, which is a positive sign for the system. The RRP/TGA dynamic will remain significant. Wolfe Research analyst Steven Chubak inquired, what sources of pressure caused card income to be muted in the quarter, specifically how much of the drag is associated with FAS 91? Jeremy Barnum replied, Steve, the card income number is a one-time adjustment due to a reward liability. This quarter's comparison is also affected by a positive one-off item in the prior period. We don't focus on card income as much as our investors do. Jeremy Barnum replied, Michael can provide you with the details, but essentially the sequential number looks a bit wonky due to a minor adjustment. Evercore IC analyst Glenn Shore inquired, when considering pricing power, what are the real-world consequences for markets and end users due to material regulatory changes? Jeremy Barnum replied, sure. So, pricing power depends on the product and competitive landscape. We think the capital increases under Basel III are excessive and put pressure on returns, which could lead to us increasing prices. This is generally bad for the real economy, but we need to see the details of the proposal before we can make any definitive statements. Evercore IC analyst Glenn Shore inquired, what are the downsides of more mortgage credit asset-backed intermediation business being pushed out of the banking system? Jeremy Barnum replied, the downside of mortgage lending is that it can be a thin-margin business with increased capital requirements making it even more challenging. Societally, when home lending is done outside the regulated perimeter, it can lead to bad outcomes for individuals and homeowners during economic downturns. Financially, profitability swings are reasonably cyclical and have been very profitable in the recent past, but this could change as the corresponding channel picks up. This creates tension between remixing and pricing power, which could mean less credit available for homeowners and more regulatory risk as the activity moves outside the perimeter. Morgan Stanley analyst Betsy Grisek inquired, can you explain the drivers of the change in asset sensitivity outlined in the 10Q? Jeremy Barnum replied, Betsy, as you know, our NE is always a challenging number to predict. We've implemented a risk management measure to help us better understand the potential effects of rate changes on our NII. We've included deposit repricing lags in our modeling, which has increased our EAR number from -1.5 to 2.5 billion. Jeremy Barnum replied, yes, all the usual caveats apply. Our NII is impacted by changes in rates, however, the exact impact can vary due to other factors. We strive to provide the most accurate information possible. Morgan Stanley analyst Betsy Grisek inquired, is it fair to assume that the 2.5 deposit beta will decrease as deposit betas accelerate in the next 4 to 5 quarters? Jeremy Barnum replied, it's a technical issue, but essentially the number was constructed using terminal deposit betas in a 100% shock to the forward curve. We've now introduced a nuance to recognize that the reprice of the beta won't be instantaneous. However, it's difficult to draw a conclusion about our expectation for beta relative to our NII guide for the next 12 months. Morgan Stanley analyst Betsy Grisek inquired, can you confirm that deposit betas are expected to accelerate and need to normalize in the mid-70s? Jamie Dimon replied, yes, the beta will increase from 30 to 40 to 50 as the next round of product is released. The lag time for this increase is 2.5, however, if rates don't go up, the lag time may remain at 2.5. Jeremy Barnum replied, Betsy, the projection of 87 coming down to a lower number is due to internal migration and potential product level reprice. The dynamics vary between large corporate wholesale and consumer segments. Deutsche Bank analyst Matt O'Connor inquired, what would make you change your deposit rates meaningfully given the current market conditions? Jeremy Barnum replied, Matt, base feedback from the field, we make projections. Jamie Dimon replied, it's clear that banks are in different positions when it comes to their needs. We take into account the local competition when setting our interest rates, so there is no one-size-fits-all approach. Pricing power is limited in our industry and betas will rise as a result. We must compete for customers by offering competitive products and rates, which we already see in some parts of our business. Jeremy Barnum replied, Matt, our core strategy is centered around primary bank relationships. This is the foundation of our success. Deutsche Bank analyst Matt O'Connor inquired, what is the trade-off that banks like yours must eventually make regarding loan-to-deposit ratios? Jamie Dimon replied, the loan-to-value ratio is lower due to regulatory requirements such as liquidity coverage ratio and capital ratios. Portales Partners analyst Charles Peabody inquired, Jeremy, what are your plans for replenishing the liquidity you showed on page 4 of your presentation? Jeremy Barnum replied, Charles, half of the change in the bank's liquidity coverage ratio is due to First Republic and the other half is from a decrease in system-wide deposits. This has been expected and does not require replenishing. We still have ample liquidity and will adjust our asset and liability mix to ensure compliance with the ratios and quarters balance sheet principles. Jamie Dimon replied, I can confirm that our cash and marketable securities total $1.4 trillion, and even if we were to reduce this to the minimum, we would still have $1.2 trillion in liquidity. This is more than enough to cover our needs and we have the ability to adjust our liquidity levels quickly if necessary. Portales Partners analyst Charles Peabody inquired, what is driving the 18% drop in NII from 22 billion to 18 billion? Is it deposits, interest reversals, or liquidity rebuilding? Jeremy Barnum replied, Charlie, this is a deposit story. We put a chart on a page that shows the dollar consequences of a 10 basis point change in deposit rate paid in terms of NII run rate. A migration from lower yielding to higher yielding deposits, such as from 0% to 4% CDs, has a big impact on margin. Even small changes in savings reprice can have a large effect when you have trillions of dollars of deposits. That's why we're being so forceful about reminding people about what we expect the trajectory to be.